All right, welcome back, folks. This is going to be class number one or part one of the model explanation. I am going to be going from the most very basic thing, and then we will move on to advanced things as the weeks go on. There is multiple different entries that I utilize for the model, but we're going to stick to the very most basic thing first because this is the foundation for everything else to work the way it's supposed to work. So today we're going to be talking about changing state of delivery, so CISD, sweepable, meaning a high or a low that needs to be swapped, sweep, a run on liquidity, and then lastly, a new changing state of delivery. So I'm going to give you guys a visual of what that would look like. And then, I'll give you a visual for both sides, and then we'll find some examples to kind of further explain the whole thing. So first, you need to understand what a change in state of delivery is. A change in state of delivery is a breaker. Okay. So you have a low, a high, a low, a higher high, then a lower low, and you get a close up below the swing. So this is what a breaker it's supposed to look like. Now, between this swing point and this swing point, for a bearish breaker, there needs to be a down candle somewhere in the leg from this point to this point. So we need to see some bearish candle here. Now, a breaker is essentially like a failed order block if you're used to trading order blocks. On an uptrend, for example, like this, order blocks are any black candles that are supposed to be holding price up, right? Like so. Now, when these order blocks fail to do so and get close below on, but also price closes below the swing point, and that's the important part, then that confirms a change in state of delivery to the opposite direction. And that's when we can see price have that pivot point to the other side. Now, it is the same thing for the upside. You just have to flip the image upside down. So high, low, high, lower low, higher high. Between this swing point and this swing point, you need to have a bullish candle. Somewhere between this low to this high, you need to have some sort of bullish candle here. That bullish candle will then act as your order block, and that's what you're going to be utilizing as your breaker for the change instead of delivery. Now, the breaker that candle doesn't have to be up here on the edge. It can be on the lower side of things, but this swing high is the change instead of delivery. So we're not entering on the breaker candle per se. We're going to enter based off the change instead of delivery. Now, this might be very basic, so you might have already known some other stuff. I'm going from, again, scratch for the folks who don't have that down just yet. But also, I want to make sure I explain how I see the, PD arrays and how I see a real changes to the delivery, because a lot of people online teach something different where they think an order block getting close above on it's already a change instead of delivery and all this other stuff, because ICT has sometimes said that kind of stuff. And I'll be honest, like I don't believe that he says that because that's the way he views it, but more so because it's a seconds breaker. So an order block on the 1 minute time frame or the 5 minute time frame is usually a breaker block on the 15-second time frame, or if it's a 5 minute order block, is usually a 1 minute order breaker block, and so on. So anyways, all right, cool. So that's the way it's supposed to look for a change in state of delivery. Go into the charts real quick, and then we'll go back up to explain everything. So for example, here on this piece of price action, we're going to use the path tool to demonstrate everything. The path tool is a really good tool to kind of see if you're drawing things correct. So starting from the bottom of the leg all the way to the, well, I guess we'll start from here, and then we'll go over. So you have a high, low, high, low, high, low, high, low, higher high, then this, lower low. Okay, so we'll pause here. So a high is 1, 2, 3 candles. The middle candle is the highest between candle 1 and 3, or it can be 2 equal highs like that. It can be candle 1, 2, 3, 4, and candle 2 and 3 are equal, but they're both higher. So you draw a line like this, they're equal, but candle 2 and 3 are higher than candle 1 and 4. That would also make a high. Now, every high needs to have a low to follow structure. So for example, this high, we're gonna skip here for a second. This high here is technically a high on the market, yes, but it has no low to it. We go to the right side of it, there's no low next to it. So this high, it's not really a high to me for structure following. So when we are following structure, we want to be able to attach to every high a low, to every low a high, and so on to follow what price is doing. That's why you see me here going, okay, cool. This is a peak point, high, low, high, low, high, low. Now, this candle here, it's a low and a high at the same time. So we go low, high, and then because on the right side to it, there is actually another low, then we can count this candle as both, and it follows structure like so. So, cool. Here, we see our changes to the delivery to the downside. We have a low, high, low, higher high, lower low getting closed down on. So when we close below this swing point here, from this high to this low to this high, that's what makes the swing here. Remember, on the image I showed earlier, okay? Low, high, higher, lower, low. Between this point to this point, we want to see a down candle. So between this high and this low, we want to see a down candle. Do we see a down candle in that? Yes, we do. What's the down candle? This red candle. This red candle here, it's part of this swing here. So this red candle would be our breaker block. Okay. Now this is one that's really funky and ugly. But we'll keep going. So we go here, low, high, low, high. Is that equal lows? Okay, so this is a good example. These are equal lows here. So because these are equal lows, I wouldn't be able to attach this to any low here. Therefore, what I need to do is move this high to the next high. And it just goes like a straight slingshot to the top. And now this high attaches to this low. And we keep following structure. So low, high, low, high, low, high, low, high, low, high, low. High, is that lower then? So high, low, high. But can I attach it to a low here? No. So we drag it up to the peak, and then that attaches to the low, and then that attaches. So this doesn't go here because there's no high to attach to. That means that this goes down, now low, high, low, high, and then I think this is a straight shot right here. Okay, awesome. So here, there's also a breaker to the upside, or it changes to the delivery. Where is it? Right. You have a high, a low, a higher high, a lower low. That was the changes to the delivery to the downside. But if we then close above here to the upside, then this is a changes to the delivery to the upside, because we have a high, low, another high, then higher high. So a lower low and then a higher high. So this image here is the same as having it like this. It doesn't have to come from a higher high when it's coming down like this. It can just be a high, a low. That high gets ran, makes that CISD to the downside, then it makes the CISD to the upside by closing above. So yeah, changes to the delivery here, and your breaker block would have to be between this low and this high. And so is there a bullish candle between this low and this high? Well, yes, there is. You always do the one closest to the peak of the pivot point. Okay. So from this swing, this would be your breaker block. It wouldn't be this down two candles here. I mean, this up two candles here. It would be the one that's closest to the swing. So this would be labeled as your breaker block. Okay. So I guess I should probably do this. Breaker. Okay. So that would be labeled as your breaker. But what I want to focus on is the CISD portion. This portion. That's what we're going to be using for our entry mechanism, the swing point. So the very peak of the move. We're not going to be using the actual breaker block. A lot of times, yes, it will come back and retap that. But a lot of times it actually won't come back. So cool. Let's go one more example and then we'll jump into the rest. So here on this leg up here, we do not count this as a CISD. Why is this not a CISD on the 1 minute time frame? Because we have a low, high, low, higher high, lower low. That gets close on here. But between this candle high, this swing point, and this swing point here, between these two swing points, is there a down candle? No, there's no down candle here between these two swing points. That means that there's no breaker block. If there's no breaker block, then there's no change instead of delivery. Okay. Now let's go down on the leg a little bit more and go here. Well, now we have a high, a low, higher high, lower low, cross, right? Which that lower low doesn't get closed on till this candle here. So when this candle here, 715, closes below 655, that's when the change instead of delivery actually happens, not up here. And then from this swing high to this swing low, is there a red candle? Yes, there's a down candle here. This red candle, which is the closest to the bottom, right? Well, it's the only one, would become your breaker block. So price should now stay below this. Like I said, though, like once this closes below, like we might not come back up here to the breaker block itself. We can just literally run off and never look. All right, cool. So that's the way it's supposed to look like for the upside. That's the way it's supposed to look like for the downside as well. So let's go back up and explain what a sweepable is next. So a sweepable is after we have our change in set of delivery, the very next valid swing high, if it's from a bearish move, or a swing low, if it's from a bullish move, is the area of liquidity we want to see get swept. Now, some people call this a double confirmation, but they're just looking for two breakers. It's not just any random two breakers. I personally, to be honest with you, have never seen anybody online talk about the sweepable the way I'm going to talk about it. So yeah, this is my concept. I didn't learn it from anybody. If anybody, I'm sure there's obviously other people out there who trade something similar to this. Since it's all ICT realistically. But I never really seen anybody else talk about this sweep the way that I do it. So it's my own thing. I didn't learn from anybody. Obviously, besides ICT, I mean, the ICT gave out the framework, and I just figure out how to utilize it. So let's move this to the side. So a sweepable will be once we have the change in set of delivery, we then form a high, a low, run the high, and we have a second change in set of delivery. So let's crop out this image for a second. And what does it look like? Looks like a regular breaker. Low, high, higher, high, lower, low. But it's a breaker that forms from a breaker. But more specifically, it has to run the very first swing high after the change in state of delivery is made. So this low here doesn't have to be like this. It doesn't have to be low, higher, high. It can be low, high, lower, low, higher, high, lower, low. It can look like this, or it can look like this. It doesn't change anything. Okay. Preferably, it does look like this. This is the preferred way, but it doesn't have to. Now for the upside, it's the same thing. Okay. It can either be this. It does not make a difference which one of the two. So when this high prints, that's what I refer to as a sweepable. So we drag this line along like this, and you will see me label this always as liquidity, depending on which time frame I am utilizing. So let's go into what a sweepable would look like on the 5 minute, because that's where most of the time, this is where you're going to want to utilize your sweepables to make the framework for trade. So we have a low, a high on the 5 minute, a low, high, lower, low, higher, high, lower, low. So changes to the delivery happen here, right? See, like so. After that gets put in, from this swing high to this swing low, we see that this red candle is your breaker block, okay? And afterwards, what we're looking for is a high to be put on the market to run it and create a new change instead of delivery to the downside. So we have a low, a high, a lower low here. Now this lower low did not have to be a lower low. It could have been a low here, or way down here. It doesn't matter. As soon as the low gets put in place, then this high automatically to me becomes what I call a sweepable. Okay. So this sweepable is what we're looking for the market to go and take so we can initiate the hunt for our lower time frame entry idea. So the market goes up. As soon as this high gets ran, you don't just enter, okay? But you do start hunting. So let's bring the replay tool here. And as soon as the 5 minute gets ran, you drop down to the 1 minute and you start looking for a change instead of delivery to the downside. Okay. So you're looking for a low. You're looking for a low, high, low, higher, high. I'm going to ignore everything that happened here. I'm just going to go straight shot just to show the example. And you're looking for the change instead of delivery. So we have a CIUC here. This red candle here is your breaker block. Okay. Like so on the 1 minute. So that's your first change instead of delivery to the downside. This is a valid short to take per rules as a base model. Now I'm going to talk about how to validate and invalidate certain trades that, don't quite make sense, how to tell if it's going to be a fake out first and then the real one will go and so on. I have a whole PDF with literally like 70 pages that I wrote for a private group. And so there's a lot of stuff to go through in my research, but yeah, we're going to go step by step. This is a stop out clearly, right? Like you see it getting stopped out. That's okay. I have a 2-bullet system. So for every trade idea, you give it 2 bullets maximum, meaning first bullet can get stopped out and you can re-enter that second trade if there's a second trade that's valid. Now, when you re-enter the second trade, if it gets stopped out, either A, you're on the wrong side of the market. It is not going to be, in this case, dropping. So it's actually going to keep going up higher. Or B, you're too early, or this is going to be ranging for a really long time before it actually drops. And it might take 3, 4, 5 bullets and you just don't know. And you should still stay out of the market. So either way, 2 bullets, you're out. Like you're done with the idea. Either you flip bias by looking at the other side and seeing if maybe there's something on the other side that you missed, or you just stay flat, stay out of the market until it figures itself out, and then you come back later on for the high time frame idea. Okay. All right. So that's what that would look like. Okay. Now, obviously, we run that high again and then we drop. So let's go back to the 5 minute real quick and delete this. Okay. So this high, remember, was the sweepable. Now, when this high gets taken by this high, then you drag this upwards like this. When then it then gets taken by this, you then drag it up here. Now, when you took the trade on the 1 minute time frame, okay, so let's pop this again. Okay. When you took the trade here on the 1 minute, because it has the CISD, imagine this line at first was a dotted line, right? As soon as you enter this trade, because we have changes to the delivery, you no longer think of this line as a dotted line. This line becomes a solid line that you're expecting to stay close. Okay. So it's a hard line now, meaning price can no longer go and hit it above it. That's what you're expecting. That's the whole idea of it. Now, again, it's a two bullet system. So if it does go above it, disrespect it, that's okay. This just changes back to being a dotted line, runs above it, and then what do? Same thing, nothing changes. You run above it, you mark the structure, low, high, low, higher high, low, yep, low there, higher high, and lower low, high, low. Okay, so you drag a line from here to here. That's your CISD. So from this swing point to that swing point, is there a red candle? Yes, this red candle is your breaker. Okay. And then this low is the CISD point once 936 closes below it. Okay. This obviously goes lower, comes back up higher. This would be your entry. So as soon as we close below it, you would set a limit order literally right on that level, right at 18,102. Your stop would go on the high of the breaker here. And the take profit on this is going to be either 2 standard deviations. I guess I haven't talked about it. Let me do that real quick and we'll come back to the example. Okay. So you need standard deviations. Standard deviations is just the Fib tool, the Fibonacci tool. Okay. You mark out 1, half, 0, and then minus half, minus 1, and so on, all the way to minus 4.5. If you are on a retracement play, most of them will play out to be 2, 2.5. If you're in a continuation play, most of them will play out to be 4, 4.5. Okay. Now, the reason why my model works so well is because we are playing continuations of the higher time frame on the lower time frame. So price is, let's say, bullish on the 5 minute or bullish on the 15 minute or bearish and so on. And you're getting a fractal idea of that continuation. So by default, let's say this is a 5 minute fib here. Okay. And well, let's just draw it like, okay. Let's say the OG breaker, OG is the very first one. So the original, I'm just going to call it OG. That's what I do. This is the OG. This is the 5 minute sweepable here, right? We run below the sweepable. And on the 1 minute time frame, there will be a changes to the delivery somewhere in this leg tighter than the 5 minute, right? Because it's a fractal thing. The 5 minute candles are this large. The 1 minute candles are this large. So you're basically getting a fractal of the larger candle that's about to expand. And that is true to the 15 minute, the hourly, to the 4 hour, to the daily, and so on. Everything is fractal, and you can utilize it this way. This model quite literally prints on every time frame from the daily all the way down to the second time frame. And you're going to see it play out. Now, I'm not going to recommend you to go down to the second time frame and do this, because the deliverance it's not going to be the same, obviously. The accuracy is not going to be the same, because you have to be aligned with the higher time frame order flow. But anyways, this 1 minute breaker here, as we can see, the 4.5 standard deviations will sit inside of the 2.5 standard deviations of the 5 minute. So you might want to aim for the 4.5 of the 5 minute as a huge expansion, but you don't need to do that because your 1 minute fractal entry already hit 4.5 standard deviations, meaning you made 4.5 R, when the 5 minute hit 2.5. And 2.5 is going to hit way more often than 4.5. That's just literally a fact. So you're basically getting the easy, low-hanging fruit of the move, and then you're out of the markets. Now, eventually, you can work towards aiming for this, the 4.5 of the 5 minute, maybe because you're in a 15-minute expansion, because this is, again, this is all fractal. So here on this 5 minute breaker, maybe we're, riding off the back of a, okay, maybe we're riding off the back of a 15-minute breaker that comes from here. Okay. And so the 4.5 here, it's about 2.5 of the 15. And so now you're riding off the fractal of that fractal and so on. It just repeats itself over and over. Okay. So yeah. So the base, what you would do is you would grab the fib tool, put it on the highest swing point to the lowest swing point of the manipulating leg that made the highest point. So from this low to this high, that's how you do the fib. If it was a bullish example, then it would just be the same but. Okay. So your entry is there. You enter as soon as this closes below, you set your limit right there. Stop loss goes here. And you would look for 2 standard deviations, meaning 2R, or 4 standard deviations, meaning 4R. Now, if you're late and, I don't know, throughout everything you expect it to go up higher than before or whatever the case is, sometimes you get a discount, right? And you make better R. So, for example, let's say you got on it here. Yeah, you get 5R instead of getting 4R. But for the most basic thing, I'm just going to teach it this way at first, just to keep things very, very simple. And then as the weeks develop, then we'll talk about how to increase the RR on these trades and so on. But yeah, so that's the example. And obviously, well, if you're in the market today, you know that we did go and hit this target. So yeah, that's 4 standard deviations there. So your exit would have been right here at 11:31, and you're done. That's it. That's it. There's nothing else for you to do. You would have walked away from the market after this happened, and that's it. Like you don't need more than this for the day. Now, this setup shows several times a day. Whether you're trading Asia, London, or New York, this setup will show in all 3 sessions, and it will be valid in all 3 sessions. Just go and look at it, do the research. You're gonna see it play out. So cool. That's for the bearish setup, and that's what the sweepable is right here. And again, that sweepable is for all time frames. So you can have a sweepable on the 1 minute. You can have a sweepable on the 15. You can have a sweepable on the hourly. You can have a sweepable on the 4 hour. Now, the pairing of the times works different depending on the time frame you're using as the base time frame. Because remember, you're using the base time frame, meaning the 5 minute in this case, to then get a lower time frame entry. So if you're using an hourly, you're not going to use the 1 minute as your breaker. You're going to use something lower than the 1 hour, but not quite the 1 minute. It's too low of a time frame. It will give you a lot of misfires, essentially. You're going to be too early for the moves. Okay. Now, this is pretty much the main framework of it. So you have change instead of delivery. That was step 1. Step 2, get a sweepable. So wait for this high or low to be formed in the market. Okay. So you're doing nothing. You're just waiting. That's the part where people get impatient because they see price dropping further and further and they just want to chase it. You're just on your hands. You're waiting. You wait for that high or low to get ran, and then you drop to the lower time frame 1 minute. Look for the new change instead of delivery. That's the entry. Hit the button. Put the fib. Put your take profit. Put your stop loss. Let it go. Let it do its thing. Don't go break even. Don't take partials. Just let the trade go to 2 or 4. Now, how do you determine which one goes to 2? How do you determine which one goes to 4? This part, it's a little bit more complicated to explain because you basically need to have more knowledge about how a breaker is supposed to print and the qualities of a high probability breaker. That literally would take me a really long time to then make another video. So for this one, I'm not going to go into too much detail of it, but I will give you the foundation basically on how to grade your breakers. We got B, B plus, A plus. B only go to -2, almost 10 out of 10 times. B plus will go to -2 or -4, and it's a very 50-50, and you literally don't know. So sometimes you might play to -4 and it works out. Sometimes it only goes to -2 and it turns around. So my advice is just do -2 instead of doing -4 by default, because you just don't know. A usually almost always goes to -4. So that's my default target. And then A plus will pretty much always go to -4. Obviously, if it's a winning trade, it might just be a losing trade. So you don't misunderstand what I'm saying. If it's, as long as it's a winning trade, it usually goes to -4 and doesn't turn around. Now, how do we grade that? Well, let's break it down from the same breaker that we have here. The grading system is, does it have an IFEG? That's number one. Okay. So IFEG, FEG, outside breaker candle, close first time. Okay. So in this, do we have an IFEG? Yes, we do. We have a inverse fair value gap. Where is it? Right here. From this low to this high here, from this candle, 1, 2, 3. We have a volume imbalance here, so we include that into the fair value gap, and that would be our IFEG. Okay. So IFEG, yes, check. Do we have an FEG? Yes, we do. FEG right here. Okay, cool, check. Outside breaker candle. What I mean by that is the candle from the swing high to the swing low is our red candle between two blue candles, or is the red candle the pivot point from this high or this low? Yes, it is the pivot point right here. Outside, it's not between two candles. This is the lowest point here. Awesome. But yes, outside breaker, yes. Close on the first time. So when we push down, when price pushed down here, did we wick here at all? Or did we close on the first time below the swing point, which is here? Well, this is the first candle that tried to close below. And yes, it closed below before the first time. That means yes. So it's 1, 2, 3, 4 things in your favor saying this is very likely to go to -4. So on this trade, you would literally set your order here. You would set your stop here. You would say your take profit right at -4, and you would just let the trade go. In this case, it would have taken you, what's that? 2 hours to well, yeah, about 2 hours to get your take profit. But you just got a 4-hour trade, and you didn't have to do anything else, and you were not wondering where the market was going to go to and from. Now, this is, again, this is A plus. Why is it A plus? Because he has everything. He has 1, 2, 3, 4. There are 4 things. If he has only 3 things, it is A. If he has 2 things, it is B plus. If he has only 1 thing or nothing, it is B automatically. So did it have a, let's say it had the IFEG and it had the fair value gap, but the outside candle was, there was no outside candle. So it was a candle between 2 candles, and it didn't close the first time around. It wicked. Okay. Well, it has 2 things in your favor and it has 2 things against your trade. So that one, it's going to be 50-50. It may go to -4. It may go to -2 because you don't know. It's a B plus. So what do? Aim for the -2 because you don't know that it's going to push further. So you just go to -2. That's it. You move on, right? If it has 3 things, you target -4. So if it has 2 things, you target -2. If it has 3 things or 4, you target -4. It's as simple as that, but you do have to look into the details. Honestly, like the small little tiny details that you don't think about are the things that make the biggest difference on the charts. And yeah, this grading works for all time frames. So it works for the 5 minute, it works for the 15, and it works for the hourly, and so on. It is not just about the 1 minute time frame only. It will literally work on all time frames. So yeah, that's number one basic class. This is the same for the 15 minute. So for the 15 minute, you pair the 1 minute as well. So you would look for your sweepable, and then you would wait for that sweepable to happen on the 15 minute sweep, and then the first breaker to the downside you take. Again, 2 bullet system. So if you get stopped out once, that's okay. You can take a second bullet. As long as you look back and everything looks clear, like as long as you didn't make any mistakes on the analysis pre-hand, you can take that second bullet. I'm not telling you to go and take 2 bullets on a losing trade for no reason. Take a trade. If you get stopped out, zoom out for a second. Is everything still the same? Yeah, everything is still the same. I am looking at the market the correct way, I believe. All right, I'll take that second bullet. Now, one way that you can avoid losses, and this is the last thing I'll leave for the first video because we're already almost at an hour, is look at the 5-minute structure and see if the 5-minute structure will have the grading system on that we talked about, the IFG, the fair value gap, and so on. In this example, the first sweepable, which was here, right? When we ran above here and we started going down and we created that 1-minute breaker, we didn't have any 5-minute structure that would meet the criteria we're looking for. There's no IFG on the 5-minute. There's no CB on the 5-minute, right? We did close below on the 5-minute the first time, but look, the breaker candle, which is this red candle, is an inside candle. Between this low and this high, the red candle is in between the two, right? So this is what I mean by an inside candle. It's not an outside candle. It's not the high or the low of the swing points. It's just between the two. So 3 out of the 4 things are missing. The only thing that's good is that it closed on the first time around at 905. That's the only thing. So this is a low probability breaker to go to -4 standard deviations on the higher time frame, on the 5-minute time frame. So if this is not very likely to push out far on the 5-minute time frame, why would we utilize the 1-minute entry that shares this high? This high is not very likely to stay untouched because this breaker is not really high quality. On the other hand, what do we have here, right? We have 5-minute IFG. We have 5-minute CB. We did close after wick. So this candle is a wick. This is the low that we need to close below. Let me drag that over. Okay. So we try to close below, snap back, and didn't close below. And then the next candle does close below it. This means that he failed to do it on the first time. So that's the first con. So you got IFG, yes. FEG, yes. You got the what's it called? The breaker outside candle, yes, you do. This candle, the 910 is an outside candle. It's just literally the swing low of the structure. So you have everything in your favor so far, right? So you have 3 out of 4. That means that this high is a lot more likely to stay untouched until it delivers 4 standard deviations. We're going to drag from the top to the bottom. 5-minute breaker, 5-minute sweepable, swept, new 5-minute breaker. I know we caught the 1-minute fractal of it, okay? And we already talked about those standard deviations. But now we're going to look at the 5-minute standard deviations because it's the same thing. You're using the 5-minute breaker to the 5-minute breaker. You're using the same breaker twice for the idea, okay? We're going to hit the replay. And where do we literally go today? We go to 4, 4.5, and then we just stall, turn around, do whatever else. And I think the market already opened. So yeah, that's it for the introduction video. Feel free to go and look for this pattern on the market. See if you can spot it. Go on the 5-minute, spot it on the 5-minute, and then drop down to the 1-minute. There is a lot more rules to go over, so I need to go over like look back periods and so on. But just worry about the day off. Just literally do the day off only for now. Don't worry about anything else. So go to the 1800 candle of every day that you're about to start backtesting. Go on the 5-minute time frame. Look at your CISDs. Look at your sweepables. Mark those out. And then go on the 1 minute of those. And then start plotting your 1 minute breakers and their projections. Okay. The general rule is whatever happened first is likely to be what's going to be continued later on. So if we've been bearish, we're likely going to continue to be bearish. If we've been bullish, we're likely going to continue to be bullish. And so if you have a CIC to the downside and then a new CIC to the upside, you don't necessarily have to switch your bias now to be a buyer. You can stay as a seller. Okay. Don't worry about switching bias so quickly. Chances are continuations are what's going to play out rather than reversals. Okay. A lot of times you get faked out if you just switch your bias. We're clearly bearish on this day, correct? Like we're clearly bearish. CISD to the downside. CISD to the downside here as well. CISD to the downside here, and that gets ran up on. And so it looks like a pivot point to go bullish, right? It looks that way, but it's not. It CISD to the downside again, and then, we then drop. So on. This is a CISD to the upside here as well. Just didn't go over it, but this is what I mean by pivot point. So high, low, higher high, lower low, higher high. When this candle here closed above this high, this was a CISD to the upside. So for the person who is getting tricked, will think, oh, CISD to the upside, we're about to continue. They're going to be buyers here, and they get smacked upside the head. That's why the model is so good, because you just do a continuation play of what's already been happening. And so, when we run up above this, we're not running up above this to then keep going up higher. We're running up above it to then go against it and go down lower. Everybody wants to be a seller right here at the peak, right? And I know ICT took a sell today here and whatever. But reality is that has lower probability for most people. Like, your skills need to just be to another level to be able to catch that. I haven't been able to figure out how to catch this reliably every time, to be very truthful. I do have some entries that will look crazy, and I'm going to do them on YouTube Live so you guys can see them. But wait for this. Just wait for the second change instead of delivery after the sweepable, and you're going to see your win rate be so much higher than before. And your RR is still very decent. It's still 2 or 4 R per trade. So one winner will literally wipe out 4 losers if it's a 4R, right? And then one winner will wipe out 2 losers if it's a 2R. So yeah, that's the video. That's the stuff. Please comment if you liked the way I presented everything. I know it was quite a bit, so I had to talk as fast as possible to kind of just get over the basic stuff. There is still a lot more to go over. This is just like literally the bare bones framework of everything. So yeah, give me some feedback. Let me know if something didn't make quite sense. And yeah, I'll see you guys on the next one. Bye.